Introducing Bluehost Cloud, ultra-fast WordPress hosting with 100% uptime. Want a website with unmatched power, speed, and control? Of course you do. And now you can have all three with Bluehost Cloud, the new web hosting plan from Bluehost. With 100% uptime and incredibly speedy load times, your WordPress websites will be dependable and lightning fast on a global scale. Plus, your sites can handle even the biggest traffic spikes without going down or lagging. And with Bluehost Cloud, you get 24/7 WordPress priority support, meaning you're connected to WordPress experts anytime you need them. Not to mention, you automatically get daily backups and world-class security. So, what are you waiting for? Get Bluehost Cloud today by visiting Bluehost.com. That's Bluehost.com.
Welcome back to another episode of Investies. I'm your host, Linda Garcia, and this week on the podcast, I'm going to share with you my favorite way of assessing the current status of the economy. But before we get into today's episode, I wanted to share a really exciting announcement and just take a moment to document what has happened and celebrate it with you all. We have, and by we, I mean myself and Cosmic Standard, who's my business partner, we have recently signed a deal with Ad Large Media. This is so exciting for Investies podcast. We have been investing in ourselves with this podcast. I cannot wait to share this journey with you all. Not on today's episode, but stay tuned for future episodes. Ad Large Media is a podcast network. It has a portfolio of over 150 podcasts, including top shows in true crime, finance, female lifestyle, history, and so much more. We are absolutely thrilled to be a part of this network. I can't wait to share with you all more details. For now, I just wanted to say thank you so much for your support, for listening to the podcast, for sharing the podcast, for rating, for reviewing the podcast. All of these efforts truly help amplify the messaging that we are working to get out, the information that we want to disseminate. We think that it is so important for marginalized community members to have a voice that represents them and disseminates this information from our community's perspective. So thank you so much. You all are also a part of this journey, and we want to make sure that we bring you along. We've talked about numerous ways on how to assess the economy on this podcast. Some of the strategies we've discussed include GDP, gross domestic product, which gives us insight onto whether or not the economy is growing or shrinking. Another method includes examining inflation data, which helps us gauge purchasing power and price stability within the market. And of course, even just looking at the S&P 500 to give us an overall idea on how key industries and key companies are performing. However, I find that by observing consumer behavior and trends, this can truly give us helpful insight in real time. This approach is continuously overlooked by heavy data like GDP and inflation reports, and I understand there is hefty validity to that data coming in, but we also need to pay attention to what the consumer is actually saying. And in this country, we make statements with our money. So where do we go to keep up with consumer spending habits? I really like to simplify things when I'm looking at the stock market and I'm looking at the economy. I like to pay attention to where we actually go as consumers. And for the most part, when Americans are shopping for essentials, we're either going to Walmart or we're going to Target. And it's truly as easy as that. It's really not rocket science to me. I think a lot of the times we're so used to making things so much more difficult than what they need to be, most especially when it comes to numbers and the economy and trying to figure out what are some of the decisions that our families should be making during challenging economic times like the ones that we are currently facing. I pay attention to Target and Walmart earnings calls. I make it a point to pay attention to those two every single quarter. If I have time, I will listen to other retail earnings reports. But for the most part, those are the two that I'm consistently looking at quarter after quarter. And just to disclose, I am not an investor in any retail company. I pay attention to this because I do believe that it gives us direct access to how consumers are feeling. In addition to that, everything always has a cause and an effect. And so I also like to pay attention to how a business is reacting to consumer spending habits. I've said this in my book. I'm sure I've said this here on the podcast many times. If I were a business professor, by the way, I went to school for business, I would most definitely make my students pick a couple companies and consistently listen to earnings reports. If you're not listening to earnings reports and you're an entrepreneur or you have an interest for business, I highly recommend that you do so. It is real-time learning, and you're getting to learn from some of the most powerful companies in the world, not just the country. We have to remember that the United States of America has the largest companies in the world. And so we're able to hear directly from CEOs, CFOs, COOs on how they are strategically handling consumer behaviors and trends. The best part about listening to earnings calls is that it is an absolutely free resource. You don't have to pay tuition. You don't have to purchase books. All you need is internet connection to begin listening to these earnings calls. That's like the best part. Free education. I'm here for it. Which, side note, if you're an investor, you absolutely should be doing your due diligence, being responsible with your investments, and listening to quarterly earnings calls for the companies that you are investing into. Again, I just like to listen in because I really want to understand consumer behavior. All of this is stuff that really intrigues me. If you feel the same way, then I highly recommend that you do the same, or you can just listen to Investies and I'll give you the cheat sheet. We're going to take a short break, and when we get back, we are going to dive into Walmart earnings, Target earnings, and what I learned. Okay, investees, I see you popping off over on our ratings. I just wanted to say thank you so much for taking the time to rate and review us. And I hate to sound like a broken record week after week, but just a small reminder, please, please, please share this podcast, share it on your stories, on your social media, send it as a text message to a friend that you know needs this type of information in their life. Head over to Apple, rate, review us, let them know how we're getting down over here on Investies podcast. And we're back. I know I said I was going to get right into Walmart and Target earnings, but before I get into that, I just want to quickly give you some tips on what to pay attention to when you're listening to earnings calls. What you're going to look for is earnings per share, or EPS. You're going to look at revenue, and you're also going to want to pay attention to any forward guidance. Those are 3 common key takeaways during earnings calls. And this isn't to say that the other information that is being shared on an earnings call does not matter, because it absolutely does. However, these are the key high-level pieces that we can actually measure from what took place in the previous quarter or in the previous year. And then, of course, we want to be able to understand how they perceive what will take place in the future. And they do this based on how the consumer is behaving through their purchasing trends or lack of purchasing trends. We're going to kick it off with Walmart's earnings. Now, Walmart reported earnings per share of 60 cents versus 52 cents that was expected by an analyst. I know some of you may be thinking, how is Walmart only making 60 cents? Really quickly, earnings per share is actually breaking down the profit for every single share that exists in the market. This is a way for us as investors to identify how much our investment made on its profit. Let's say that we have 100 shares. We would simply multiply our 100 shares by the 60 cents it brought in, and that will give us an accurate reading on how much profit our investment made. Now, earnings is revenue minus costs and expenses. So this is the money that it has made, free and clear. And then to add on to that, there is an analyst that analyzes an expectation and says, per the expectations of Walmart, based on XYZ, we are expecting Walmart to make 52 cents a share. These analysts are typically assigned each company they analyze, and they have been analyzing these companies quarter after quarter. So they really have a pulse on the company, and they can really generate an accurate expectation of how much a company should be bringing in, how much it should be expensing out, and costing out. This helps publicly traded companies stay accountable to an outside source. And so every single quarter when a company reports, they either miss their earnings per share expectations or they beat their earnings per share expectations. In this case, Walmart brought in 60 cents versus 52 cents expected, so they beat their earnings expectations. This is positive news for Walmart. We still have to see how they did on revenue, and we also have to see how they did on any forward guidance. Revenue for Walmart came in at $161 billion versus what the analysts expected at $159 billion. Now, this is $2 billion more than what was expected. This is positive news for Walmart. So now we have earnings per share that was positive and revenue that was positive based on what the analysts expected Walmart to bring in. It's important for us to understand that we are currently measuring Walmart's revenue and earnings per share based on what an analyst is expecting. However, this is not measured against what Walmart did in the previous quarter or in the previous year. A lot of folks may get confused and they think that when a company is beating earnings per share or beating revenue, that they're beating last quarter's markers or a year ago marker. And that is not always the case. This is why it's also important for us to look at an income statement balance to see how they are actually doing year over year. What an analyst does is provide an adequate expectation based on how the economy is performing. And I do believe that this is a pretty fair measure, given that we cannot expect for a company to continuously improve their revenue, although that would be great. It's more realistic to make adjustments according to how the economy is performing and how consumers are behaving. This is why I think that looking at retail is extremely important when assessing an economy. Now, what we are going to do is compare this quarter's numbers to the same quarter a year ago. Normally, I would be sharing with you the EPS for last year. However, we have a special case with Walmart in that they recently had a 3-for-1 stock split in February of this year. So if I were to compare the EPS from a year ago to the EPS today, we would have an inaccurate reading because we now have 3 times the shares in the market. I would also be comparing quarter over quarter. I picked the perfect time to do this episode with you all. I can't compare the quarter over quarter because I would have another inaccurate reading in that last quarter's numbers reflect what was spent during the holiday season. And so if we were to compare a holiday season, which is a peak season, more revenue is coming in, that would also be unfair. I do think it is good that we are going through this together so that you can see the small nuances that we do have to take into consideration. I literally just spent the last 20 minutes stunned by the difference in EPS. And then I was like, you know what? I think Walmart had a stock split. And so I went down that rabbit hole. They did have a stock split. A stock split is when a company decides to add more available stock into the market. So that would be an inaccurate reading. So what we're going to do is we're going to solely focus on revenue to give us an idea of how this quarter's revenue compares to the same quarter last year. In the same quarter last year, Walmart reported $152 billion. As a reminder, in this quarter, they reported $161 billion. We can see that that is a $9 billion increase. This is a positive increase. Let's see what other information we can extract from this earnings report. Here's what the CEO said. We've got customers that are coming to us more frequently than they have before, and newer customers that we haven't traditionally had. And they are coming into Walmart, whether it's a virtual store online or whether it's one of our physical stores. Now, they have been saying this for over a year now. One of the things that Walmart has consistently talked about is how they are gaining business, and they believe that they are gaining this business away from Target because they do have the reputation of having lower prices. Now, in this report, they also attribute increase in the grocery business because of how expensive fast food chains are. Folks are finding that making food at home is much more cheaper than buying fast food. Now, this wasn't always the case, so they are definitely benefiting from those price increases in fast food, and they are gaining customers away from Target. So it's no surprise to me that they have increased in revenue because Walmart will always do really well during a challenging economic time. It's when they start to suffer that we need to pay attention. All right, we're going to go ahead and move into analyzing Target in the same way. This is going to give us more information as it broadens the story. Right now, we have a one-sided story, so we need to get the other side. And then we can have a more accurate assessment as to how consumers are doing. Target's earnings per share came in at $2.03 versus $2.06 expected by the analysts. Now, you might be thinking, oh, it's just a 3-cent difference. That's not a big deal. No, it is not a 3-cent difference. We have to remember that these are 3 cents per share. Not to mention that the stock market doesn't even like when you're a penny off. So these numbers do add up and it does matter. Remember that as an expectation that the analyst sets, this gives us a barometer as to what target should be meeting. And so the miss is an indicator that something can potentially be wrong, even if it is by just a few cents. Now, it is also really important for me to highlight the difference in earnings per share at Target from earnings per share at Walmart. Earnings per share at Target came in at $2.03. Earnings per share at Walmart came in at 60 cents. Please do not make the mistake of comparing one company's EPS to another company's EPS. These numbers shouldn't be compared because the number of outstanding shares, meaning shares that are accessible to the public, are different. So do not make the mistake of thinking that Target is better to invest in because their EPS is tracking higher. Now, looking at revenue for Target, they brought in $24.53 billion versus what the analysts expected at $24.52 billion. Target beats revenue expectations and misses earnings per share. When we compare Target's revenue to Walmart's revenue, it really paints the picture as to why comparing one EPS to another EPS really doesn't make a lot of sense. Target's revenue was $24 billion. Meanwhile, Walmart's revenue was $161 billion. If we were to just look at EPS, it would be easy for someone to think that Target is a much bigger corporation, when in actuality, Walmart is bringing in so much more revenue than Target. We aren't really assessing these two companies to compare which one's the bigger one and which one's the smaller one. We're looking for key indicators on consumer spending. So now what we're going to do is we're going to go ahead and compare how Target did in the same quarter a year ago. So when we look at the same quarter a year ago, we will see that total revenue for Target was $25 billion. This is approximately a $1 billion decrease from Target's revenue a year ago. Now, when we look at Walmart, if you remember, they actually had a $9 billion increase in revenue from the same quarter a year ago. I just want to reiterate, we're not really comparing the strength of one company to another. We are simply looking to identify what the consumer is doing. Walmart has been stating that they are gaining market share, and we can see based on the numbers that this is evident. 2 days prior to Target's earnings call, they released a statement letting investors know that they are going to reduce the prices on 5,000 frequently bought items. The release of this statement 2 days prior to an earnings call is already a warning sign. They are working on managing expectations for when the actual earnings call takes place. This is already letting us know that there could potentially be some relatively serious issues with the health of the business. In the statement, Target disclosed that it is focusing on reducing the cost of their staple products, which include milk, meat, bread, fruits, vegetables, as well as paper towels, diapers, and other brands that distribute essential items to its consumers. The CEO does share sentiments in the statement and says, "We know consumers are feeling pressured to make the most of their budget, and Target is here to help them save more." Now, I don't know about Target being there to help folks save more, to be quite honest. I actually do believe them when they say that consumers are feeling pressured. I think that they may have these essential items sitting on the shelves, and it is important for them to move the items off the shelf and therefore relieve their own pressure and lower those prices. The lowering of the prices to me is what I found the most concerning in looking at Walmart's earnings and Target's earnings. It is telling me that officially the consumer is under massive pressure, so much pressure that it has already forced the corporation to lower its prices. This to me is an indicator of the pain that is currently taking place in the market. This is the type of pain that is going to start to lower inflation. I have yet to hear of retail companies focusing on price cutting like I did in this report. And I can see why when I compare Target's revenue to the revenue that it brought in last year. We're in trouble. The corporations are in trouble. They're starting to feel it now. And so what will happen is if Target begins rolling back its prices, Walmart is going to have to look at the comparison of their prices and make sure that they are maintaining the competitiveness in their pricing. And so this is when we actually start to see the relief for the consumer. And we start to see inflation begin to decrease. While it is unfortunate to see consumers in pain, this is the type of pain we need to relieve ourselves and put the pressure back on these corporations. For Target's forward guidance, they are sticking to their expectations on earnings per share and their expectations for revenue. Typically, when a company is hurting, they were lower expectations. However, we have to pay attention and critically think through this. Target did lower prices to over 5,000 products, not to mention that it had already lowered prices on 1,500 products the quarter before. And so the reason why they are confident that they'll be able to meet next quarter's expectations is because of the price cutting that they have made. They're expecting that customers will return their shopping at Target. But because this is a game of chess and not checkers, Walmart is making significant improvements to their stores. They are remodeling to give Walmart much more elevated feel. I'm guessing that one of the reasons they are doing this is so that they can retain any Target customers that they have attracted. All in all, the biggest takeaways is the consumer is definitely not doing great, placing the pressure now onto the corporations. This could mean that we might see a drop in inflation. This can impact a CPI report and potentially let Fed Chair Powell know that it might be time to decrease interest rates. We shall see. This was a really long episode compared to our previous episodes. I hope that you enjoyed listening to this episode as much as I enjoyed sharing this type of information. It's important for me to walk you through what I'm looking at in the market and what I'm paying attention to, and of course, share with you how I do that. You're listening to Investies. I'm your host, Linda Garcia. Investies is a Cosmic Standard and In Luz We Trust production. A special thank you to the team, Asia Simpson, Eliza Smith, and Jacob Winnick.